Good morning, everyone. I'm Martha Stokes. I'm a retired chartered market technician. I specialize in cycle theory and analyzing dark pool activity because I was on the buy side and the dark pools are the buy side. So what I enjoy sharing my ideas with you and things so that you can become a better trader with TradingView's great platform. It's an awesome platform, really strong and powerful, and has lots of different things that you can do with it. I want to talk briefly about volatility versus velocity. A lot of people assume that the VIX is something that they should be following or tracking. And if you're in options a lot, you may be following the VIX or implied volatility. And I need to let you know something that you don't know. So this is the facts. Professional traders use futures contracts in the S&P 500, E-minis, and other things to mitigate their risk. They also use option puts extensively to mitigate their risk. They have a 1 million, 5 million, 10 million lot order, open order, buying a stock slowly or buying it quickly, grabbing all these people who want to sell the stock, and then they're holding it because they have a very strong indication with their indicators that are similar to mine, and also other factors that they know that they are going to hold that stock because it's going to move up. How I know this is because one of the options market makers was a really good friend of mine years back, and I gave her some stocks to look at, and she says, "Martha, I can't believe that you found this stock. There's this guy, this professional trader, prop trader, is trading 5 million shares on this stock. It's going to go up." And I said, "Really?" "Yes, he's buying option puts like crazy. He's buying option puts like crazy." And I said, "Well, then is it, everybody says that option puts are going to go down?" She says, "No, no, 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 no." She says, all the professional traders use option puts and futures and all the others, E-minis, as mitigating to lower their risk. It's a cheap insurance policy. It's a cheap insurance policy for the professionals who are trading millions of shares on a swing trade over a few days. They get in here. And then they buy some option puts, a whole bunch of them. And you option traders go, "Oh my gosh, the options market knows that Amazon is going to go down or the market's going to go down. Oh no, we gotta buy puts." Meanwhile, the stock runs up or the indexes run up and continue. And then, of course, there's some selling there. And so the options puts go, "Oh, ha, ha, ha. Yeah, we're in this and this is going to be great. We're going to make a lot of money." And all of a sudden, the stock goes up even further. Yeah. Option puts, a high number of option puts does not mean that the options market knows that a stock or the market itself indexes, meaning the indexes, are going to go down. It actually means that the professionals are mitigating their risk because it's cheap for them to buy. It's an inexpensive insurance policy to buy a whole bunch of option puts, and then when they're in profit, then they start selling those option puts to retail traders who are options traders. Don't do this. It's a bad idea. You will lose money on your options puts if you believe that the options market has some magic crystal ball that can tell you that because there's a high number of option puts, the market or the stock is going to go down. This has been going on for 20 years, folks. And so you need to understand that everything you're told or everything you believe is probably needs to be realigned to the professional side. And so I'm trying to teach you the professional side of the activity. So we would consider this very volatile. A lot of people would say, "Oh, this is volatility." But did you know that the VIX for the 1 to 5 day swing trade only has an efficacy of 20 to 25%? That means that 80 to 100% of the time, it is wrong. So that makes a real problem for you because you are trusting this. The VIX is for long term. It's set out for a 30-day, combined with the options contracts, 30 days out, predicting. Everybody wants to predict the market. In the 90s, when it was developed, everybody thought, "Oh, we can predict the market." No, you can't. and especially now. Why? Because we have 20 plus, more than 20 new technologies all emerging and starting to come to market. AI is just the beginning. I've talked about this before, but you've got to get this in, wrap around in your head. Why is Amazon moving like a rocket? Well, down here, all this presumed volatility is a bottom. It's actually a W bottom, short term, a couple of months, February, March, April, and then it takes off. And I mean, this is a buy zone by the dark pools, and they've been accumulating. It's boosted its percentage of shares held by institutions. You can check on the NASDAQ for that. It's a 3-month report, so a lot of times it's 3 months behind, but it does tell you if, and I can see right in here, buy zone, right there, and they're buying the stock. This was the previous fundamentals. And then it had the same earnings, 195, as it did over here. So all of a sudden, it's gapping down. Dark pools go, how low can it go before we decide to buy it? And it drops and it drops, and everybody's trying to sell the stock. And then, of course, it starts to accumulate because it had a good report. It just didn't have super growth. Why? Because it was building infrastructure. It was designing things and getting partnerships going. And it's one of the most dynamic companies right now in AI. AWS, brilliant, brilliant strategies. Mary has a partnership with NASDAQ to open up the whole European community to the stock market. Big, big, big. It's over speculated right now. Okay, so profit taking by pro traders, and they're taking a little more profit because what they see is they see, okay, this is exhausted and it could go down, so we're going to take our profit and be happy. You always try to get out at the top, some of you, not all of you, and then of course the next day it goes down and down. It may even go down further. It has to correct. It's over speculated. It is a vertical angle of ascent. Look how steep that is. When you need to trust your instruments, TradingView is an awesome platform. Awesome. And you don't trust your instruments. You rely on news, you rely on the VIX, you rely on implied volatility instead of looking at the chart and seeing what's going on. This is a massive fundamental level. It dropped down. It stopped the rundown very quickly. That's a very minor area for buy sides accumulation patterns, and they're in the mix here. Oh, we're pinging, 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 ping, 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 ping. And of course, we have sellers. Oh, sell. Oh, sell on the bounce. Oh, sell on the bounce. Stop doing this. Don't do this. Please don't do this. Okay, so then you want to get into the nudges and the setups and then ride the wave up. And when you see these little candles, the pros are getting out. They're very careful about how they get out. They can strike the penny because there's other buyers coming in, and then it gaps up and sells down, gaps up and sells down. This is a warning signal. This is a sandwich, or as some of you would call this, an evening star. And then you have a couple more runs up, and this is a fake out. This is a fake out. It's got to correct and probably back down to here. It's at a new all-time high, which is magnificent, but it has to shift sideways again, because the dark pools aren't going to buy anymore as it's running up. They're riding the run. The pro traders are riding the run. You're chasing the run. Stop doing this. Stop chasing runs. Stop relying on recommended stocks, because by the time they recommend the stock, everybody else is already in it, and you're chasing that run, or you're chasing that HFT gap up or gap down. You can't chase HFTs. You have to ride with the wave. You have to go with everybody, not trading and chasing. And if you do, you will have far greater success. And one of the little darling secrets that I teach my students is that less trading is more profit. You trade too much. All of my students are required to have a trade management planner. You should have a trade management planner that sets out for the entire month how you're going to trade, your risk tolerance, what price range you can afford based on your capital and your experience, how many the share lot size you should be using, the risk to reward ratio, how much risk you should have. It should usually be 1 point risk to 3 point to 6 or 8 point profit potential, and all these other factors. And if you do this, then you will have far greater success because you are managing it like a professional. I want you to learn to trade like professionals trade. They don't go and talk on YouTube. They're very reclusive. They don't share their ideas. They don't sit in chat rooms. They're by themselves because they're confident that they know what they're doing. Most of them were floor traders at one time. So we're teaching you how to be like the independent professional traders who make very high incomes and are very happy and trade less, far less than you do. Far less than you do. And they have confidence to hold. If there's a slight down day, it doesn't bother them. You, a small down day, and you start trying to sell out. So you have to stop this behavior. So I was giving you some information today that you can chew on and think about. And thank you to those of you who have complimented me and written me and let me know that you're happy with what I'm doing, because I am trying to help you become better traders. I'm Martha Stokes, and that's the topic for today.